Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hey everyone, Daniel Snyder from Seeking Alpha. Welcome back to another episode of ETF Spotlight. Today we are joined by Ivo Kolchev. He is a Seeking Alpha analyst who has been writing on the site here since about 2021, if I remember correctly. Ivo, I'm excited to dive in today, the world of real estate. But a lot of times here on Seeking Alpha, we talk about the American U.S. real estate market. We focus on the REITs and how the real estate market in America is doing. But today we get to dive into conversation with you about not only U.S., but the ex-U.S., because you recently wrote an article here on Seeking Alpha comparing VNQ, which is the Vanguard Real Estate Index Fund ETF shares, compared to the VNQI, which is the Vanguard Global ex-US Real Estate Index shares. So wanted to first get your high level approach. How is it that you're viewing the US real estate market versus the international real estate market? And we can go into all the risk and the upside and downside and dividend yields. But first, wanted to see what's the high level approach here.
Hi, Daniel. Thank you for having me. So the high-level approach, basically, when comparing the two ETFs, the first thing I want to highlight is that we basically have really different accounting approaches. In the US, you have real estate held at book value minus depreciation, while in international markets, you have real estate held at fair value, which is calculated by independent appraisers basically every 6 months or so. The bottom line is that for international REITs, book value is a much more useful metric to look at relative to US markets. My thesis basically was that international REITs, they're still trading at roughly a 10% discount to book value. And basically, coupled with a slightly higher current dividend yield, that was my bull thesis for international REITs outperforming US REITs from here.
Yeah, it's a really great point that you make, that they're not really valued apples to apples, right? The accounting standards that we have here in America are not necessarily those that are held by the international standards, which you write about article here. But also with America, we have different interest rates than a lot of other countries do in the world. So how does the interest rate, where it has been for the last couple of years now, after the incredible hiking cycle we've had, and now we're kind of seeing that slow cut effect kind of trickle through, or at least the traders are expecting it going forward. So what should investors and traders be thinking about the real estate market in America as these interest rates come down to normalization?
Well, if you look at both ETFs over the past 10 years, they have really grown dividends at a very slow pace, basically in the low single digits. And that's just the interest rate effect you mentioned. Basically, these REITs, they had to refinance their debt at higher rates, and that's how they couldn't grow distributions much. But now, as you mentioned, interest rates are going down, both in the US and internationally. And over the next 10 years, I expect dividend growth to pick up at both ETFs. And also in the US specifically, a near-term effect we will see is that money could move out of money market funds. Basically, last year you could get 5% in a money market fund. Currently, you can get about 4%. Maybe this time next year, you will be able to get 3%. So in this respect, the 4% dividend yield offered by ETFs, it will be highly attractive.
Now, what about currency fluctuations, right? Because that's one thing you have to keep into consideration as well, is, for a US investor trader that might be watching this right now is thinking, okay, well, I don't have to worry about the currency fluctuation risk of investing internationally. And sometimes that might deter people from going to that international real estate market route. What would you say about the currency risk for these funds?
So this year, this has been the main driver of returns for international REITs, basically the weak dollar. But in future years, I don't see the effect being pronounced to the same extent, but I do expect some further dollar weakness, partly driven by interest rate cuts, partly driven by geopolitical risks. And I do expect to have a small benefit for international REITs, just measured in US dollars, but it will be really small and really uncertain. So if I divide the return components into three, the current dividend, which is the most certain return component, because basically REITs, they try to set the dividend at a rate which they won't have to cut in the future. So this is the first return component. The second one would be gains in the value of real estate. And the third one, it would be the currency tailwind. The third one I see as the most uncertain.
So you mentioned dividend.
Mm-hmm.
Let's dive deeper into that. So you had mentioned in your article, VNQI, the international ETF, pays a little bit of a higher dividend, but how can we really tell if that dividend is sustainable? Is that just because we're supposed to trust Vanguard and the companies they pick and we think they know best?
Yeah, so you're right to point this out. Basically, Vanguard, they don't disclose information about payout ratio. So payout ratios, they look at what proportion of the cash flows the REIT is paying out as a dividend. And basically, currently, we can't compare VNQI and VNQ because they don't disclose the payout ratio. That said, I do expect that both in the US and internationally, basically companies, they set the dividend at the rate that they won't have to cut, and potentially they'll be able to grow in the future. So coupled with the fact that international REITs, they're still trading at a 10% discount to book value, as I mentioned, that's where we get slightly higher yield for international REITs.
So when we talk about VNQ, you've broken it down the top three sectors or industries, if you will, within the fund, which was healthcare, retail, and telecom tower. Now, thinking forward to the future here, right, and innovation and growth and where the market dynamics might be going, is that where you think the fund should be invested heavily over other different industries within the sector? So I only ask that because I think about telecom tower, for example, which is, yes, has been the standard for a long time, but now you're seeing this future of potential cell phones to satellites and other different waves and technology coming into the fold. Do you expect any rotation within that fund?
So that's a fair point, but basically the way these ETFs are constructed, they're really low cost, but they're passive and they just track market capitalization. So the trends if you're mentioning, if they play out in the future, basically we'll see the market cap of telecom REITs shrink, offset perhaps by growth in the market cap of data center REITs. So naturally, this will flow into the retail allocations, but it will happen over time, not something over the next 1 or 2 years. So really gradual process I see here.
Okay, good to know. I'm glad we clarified that. And then one last question for you, I think I have about VNQI is we're looking at the different countries, and you kind of broken down that Japan seems to be the largest country here, and then you have Australia, Hong Kong, United Kingdom kind of rounding up, and Singapore to round out the top 5 here. Is there any geopolitical risk, or what should investors be thinking about before they go and just invest in real estate, which is going into those countries mainly?
Yeah. So the main risk I would highlight here, maybe you do have like 20% emerging markets exposure at VNQI. So on the one hand, it's a risk, but on the other hand, it's also an opportunity because, emerging markets, they're showing the highest GDP growth. That's where real estate is expected to increase the most in value. So investors can look at it maybe higher volatility, but higher return down the road as well.
All right. So right now, I'm going to put you on the spot. If you had to pick one today to be your investment, you can't choose both. You can't weight them. You can't do anything like that. VNQ or VNQI? What is your pick?
Yeah. So my pick right now, it would be VNQI because, as I said, it does offer a slightly higher current yield. They're still trading at discount international REITs. And I do expect some further weakening of the dollar, so you should see a nice currency tailwind over the next few years as well. But not to the same extent as in 25. So this one was extreme.
Amazing. Well, let's go ahead and leave it there. Thank you so much, Ivo, for coming on today, talking about the real estate market with me. Everyone, if you want to read more of his research, highly encourage you to go follow him here on Seeking Alpha. He has passed all 3 levels of the CFA exam. He is currently a doctorate student getting his PhD in finance. So love to talk to you every time we can grab some time with you, Ivo. Thank you so much for joining the program today.
Thank you, Daniel. All the best. Bye-bye.